Hi, I'm Eddie Sunergy, and welcome to Your Finance TV. It's Friday, and it's time for some musings. I'm stepping in for Dux, but I'm still here with Jay Pulaski, founder at TPW Advisory. Jay, how are you, sir?
Great to see you, Marty. What happened to the other guy? What,
What do
off
you
playing
think?
golf?
It's a Friday in the summertime. He's hitting the golf balls, right?
I tell you, you're a really very forgiving partner
Hey,
because
you
I know
know what,
I
Jay?
would be so
Someone's
forgiving.
got to do the work.
I know that feeling. I got that feeling.
But we'll carry him. So, as always, thank you for joining us today. And I'm very excited to read your musings, as always. And this week's title, Transition Time. I feel like there's something you want to tell us here. Let's talk about transitioning, shall we?
Well, it's an obvious or somewhat obvious play on the transition of seasons, right? We're transitioning this week from spring to summer. Wednesday was the official start of summer here in the US. And, it's again kind of like the markets, it's all over the place, right? Weather here in New York is a good 15 degrees or more below seasonal averages. We should be in the low 80s. Instead, yesterday, we were in the mid 60s. So, and it's the same in the market. So it's really a metaphor of transition. In the markets, we're transitioning from bear to bull, right? Just recently, as a week or two ago, we were talking about the new bull market, transitioning from rate hike cycles to rate cut cycles, from inflation spikes to disinflation, from commodity booms to oil prices can't get out of their own way, from recession to no recession, back to recession. So it's all that idea of transition and where we are in the cycle. And I think, hey, we had a 15% start to the year. I think it was one of the best starts to the year in 20 or 25 years, one of the best all time. So naturally, one would expect a pullback. And the question is the pullback healthy? We think it is. We wrote about it last week, and over the last several weeks, we're believers in, BTFD. I don't want to say it's a family show, so I won't say what the F stands for, but buy the dip and the opportunity set as it presents itself. And so that's really the thinking behind the title.
Well, that makes a lot of sense, and I'm happy to jump on board into this transition into summer. But let's get down into the nitty gritty, shall we, Jay? Let's talk data points. What are you seeing out there?
Well, exactly, Marty. I mean, the market is reacting. There is in transition. It's reacting from one data point to the next. We had the UK inflation number being worse than expected. That kind of kicked off concerns. And then you had the PMIs coming out in Europe being weaker than expected. The composite just holding barely above 50 at 50.3 on the flash composite. That's worrisome because, we don't want to see that number going below 50. And so we went from higher than expected UK inflation, getting people worried about inflation, to worse than expected composite PMI, leading to big rallies in bonds, particularly in Europe. I think there was a close to 15 to 20 basis point pullback in the German 10-year. I know there's been a pullback, obviously, in the U.S. Treasury market as well. So all sorts of back and forth given the transition. But, when we look at things, we see data points like housing. Housing is a clear issue, was a big drag on the economy last year. Housing is clearly bottomed. Housing starts are up, single family up 10% year over year. Multifamily starts are the first time since the 70s that multifamily starts are running ahead of single family starts. Single family starts themselves were up 20% month on month in the month of May. So we look at data like that. We look at the Empire State surveys and the Philly Fed surveys suggesting much better times ahead for the manufacturing side in both of those reports. And so we continue to really think that the question of will manufacturing catch up to the stronger services, or will the strong services catch down to the weak production side? We're in the camp that says manufacturing is going to pick up to services, and that's going to support, the better economic tone that we have been expecting and looking for. So net net, when we put it all together, we expect to see that middle path between high inflation and deep recession continue to trod down that path. We expect to see positives that we wrote about in our latest monthly, more benign inflation outlook, the new industrial policy in the U.S., the end of yield curve control in Japan, the focus on domestic demand-led growth in China. These are some of the new things, the birth of the new, as we titled our monthly. These are some of the new policy points that we think are going to support global growth. And then most importantly, we want to think about earnings and what the outlook is for earnings, obviously.
Well, it's a great spot to roll into your next segment. So earnings have obviously been a focus for both sides, bears and bulls. And a lot of talking heads have been saying, the market is priced in on an earnings front. What are your thoughts on the earnings side?
Well, that's really the be all and end all for equities, right? They don't work off of growth. They don't really work off of inflation. Stocks work off of earnings, and so it's interesting for all the headlines and back and forth, as you correctly note, that FactSet reports that since April, the 12-month forward, so kind of the rolling 12-month forward outlook for earnings has picked up about 3%. And that 12-month forward outlook now is suggesting that U.S. earnings are going to come in at around $232 a year from now, so June of 2024. For the full year of 2023, earnings are now projected to rise 2% year over year, so a new record to about $220 for the S&P. And so that's a pretty decent earnings outlook. And most importantly is the fact that rolling outlook is continuing to show, higher earnings expectations rather than lower. And as we get through this week and the big rebalancing of today, next week and the July 4th holiday, the end of June, but after that, earnings are the next thing, right? Earnings in the Fed. And so when we think about the Fed in July, we expect no rate hike. The market is pricing in about 75% odds of a rate hike in July. We disagree completely. We think the June inflation number, which will come out just before, or a week or so before the July Fed meeting, is going to show headline inflation running under 4%. Under 4%. Because remember, June of 2022 was the peak in inflation, where it rose 1.2% month over month. So we're going to drop to 1.2, pick up a 0.3 or 0.4, and that's going to drop that year over year headline to well under 4%. We just don't see the Fed raising rates when the headline inflation number is under 4%. And so that plus, the decent earnings outlook, plus what we think is going to be another important focus, which is the shift to the out year, right? You and I have been in this business a long time. We know that when analysts and strategists and investors come back from the summer vacation, they focus on the out year, right? So we're going to be starting to focus on 2024. And there we think, rate cut cycle, housing bottom, manufacturing picking up, China doing better, Japan continuing to do well, emerging markets cutting rates in Latin America and Brazil and Chile and Mexico are all supportive of higher risk asset prices as we look out over the next 6 to 12 months.
So, Jay, thank you for breaking that all down. It actually paints quite, I don't want to say like the overly bullish picture, but it's a very positive and structured argument for the next couple of years. So, that being said, how are you positioned, and how would you kind of advise people to position themselves?
Yeah, no, that's obviously the challenge, right? You can say all you want, but at the end of the day, it's all about, What are you owning? What are you buying? What are you selling? And as you know, Marty, here at TPW Advisory, we offer two model portfolios to our clients, right? The first is our flagship global multi-asset model portfolio. And there we've been running kind of a barbell strategy. We've been running within US equities a barbell between tech and cyclicals. And then overall within our equity bucket, we've been running a barbell between US and non-US, with that non-US being a slightly bigger part of the barbell. So it's more of that type of barbell. And really, we've been focusing in more recently on some of the emerging markets. And as we just touched on, we expect EM central banks, which led the way to the rate hike cycle a couple of years ago. They started hiking ahead of the Fed, and are now, you have situations where Brazil, for example, has 10% real interest rates, 10% real interest rates, 13% government rate, 4% inflation, or somewhere in that order, but real rates roughly around 10%. And so we think there's lots of room for rate cuts, and we've been really adding to that EM equity and fixed income piece. So then on the fixed income side, very focused away from treasuries and governments, much heavier in credit and in emerging market, local currency debt. We have quite a big position there. And then in the commodity space, we're running kind of a barbell between the precious metals, gold mainly, and then the oil and copper side. And that's really been the sore thumb, as I say in the musings, of our asset allocation. We have been overweight commodities, and they haven't really supported the idea of a more robust global growth outlook. So that we're watching closely. And again, it's this issue of transition from destocking to restocking, right? Goldman Sachs wrote a couple of weeks ago about the what they call the most massive destocking in the oil markets, that physical oil markets, that they've ever seen. So you have these weird juxtapositions where the IEA, the International Energy Agency, is forecasting a tighter second half for the oil market, right? Demand picking up while supply remains constrained. And yet, if you look at WTI or Brent, they can barely get out of bed. And so it's this, again, this weird kind of in-between transition. And I guess the commodity investors are, saying, "Show me the money," right? Show me the growth. And then in the equity market, and we can finish here, we just think it's interesting to note that we have $1 trillion short position in U.S. equities, the biggest short position that we've had in over a year. And so we've had a 15% start to the year, the best start in decades, and obviously a huge amount of skepticism towards that. But to us, that tells us that we can look to buy the dip, buy the healthy pullback, because that, again, 15% in the first 6 months, naturally you're going to get a pullback. The question is, what do you do with it? And that short position, that $1 trillion in shorts in the U.S. equity market, to us is actually a cushion and provides the underpinning for us to, buy the dip. And so we reposition our models. As you know, we update our models once a month. That's going to come in about 2 weeks. Next week is our monthly, and we're excited about that. That's always a big read for us. It's tends to be about 5,000 words, 20, 25 charts and tables that we curate from typically 20 or so different research sources. And so we're excited to put that all together. And then the following week, we update the models, and we'll see how, that we talked about the global multi-asset model. Let me just finish on our second model. I almost forgot to mention it, our TPW20, which is our thematic model. And there, our barbell, again, is future tech and climate. And both are interesting to us because both have been through, long basing periods, right? The last 12 or 18 months. I talked about this with your with your buddy there last week or the week before, that when you zoom out and look at some of the charts, lots of things had that huge run up around COVID, then the collapse, and they've gone basically sideways for a year, 18 months. So really interesting when you think about the next couple of years. We think the next couple of years are actually easier to forecast than, let's say, the next 6 months as we're in that transition. And the charts line up with that as well. The charts on a long-term basis look like there's just, great basing and then a lot of room to move higher as the global economy picks up due to those things that we talked about, those new policy initiatives around climate, COVID, and conflict. So we're trying to ride the transition through barbell and then look to be opportunistic as we move into what we think is going to be, our analog continues to be the second half of the 1990s, where you had the last time you had a CapEx boom in the US, the last time you had real productivity growth. We think that's going to come from AI in this cycle. And so that's our analog. It continues to be the second half of the 90s, which was a quite positive period for risk assets.
Well, Jay, it sounds like things are falling into place as you ride your barbells, and we'll keep looking at buying the dips. So I'm looking forward to your piece next week, your monthly. And if I'm a viewer, what do I do? How do I get hold of it? How do I get TPW advisory content, Jay?
Yes, it's really quite simple, Marty. It's just go to Pulaski.com and there's a sign up opportunity. You can sign up to receive our weekly musings. The first 3 Fridays of every month. The monthly comes out on that last Friday of every month. And then for clients who are model portfolio delivery service clients, obviously that's a pay-for service, and there they get the updated models typically in the first week of every month. But the writing is freely available at Pulaski.com to sign up. And then the model portfolio delivery service, there's another opportunity to reach out to us and get in touch about accessing our models.
Fantastic. Thank you for sharing your thoughts today. I look forward to next week. And to our viewers, make sure you tune in next week. And of course, don't forget to sign up, subscribe, and like to Your Finance TV. Otherwise, you won't get to see people like Jay. So have a fantastic weekend and good luck investing.